Sit there and look pretty, Mike. Interesting. If you can hear me, everybody, we're just having some technical difficulties. Sorry about this. I have to enable, you know how it comes up with that, thing that says allow camera? Do you know how to do that? Yeah. Gotta love these technical difficulties.
It must be in the browser.
Wow.
What is the browser?
So this is a Chrome.
Oh, this one.
Yeah. What's it called? Pop-ups or extensions? More tools.
Open Chrome, go to settings, content, camera.
Settings, content, camera. Where's settings?
There should be the hamburger.
Right. So if you guys are just watching, that's all good. Just be patient. We're still trying to sort out our technical issues here. Settings. There we go. Okay. So
content, camera.
Content and camera. Where's that? Right there.
And under default behavior, sites can use your camera.
Where's that? I can't see how to get that done.
Select a during the live stream setup, YouTube will prompt you to select a camera, choose your camera from the middle option, but that's probably after you've already enabled it, maybe.
Maybe if I don't want to end the stream, but I want to pop up dashboard. Is that it? Probably not.
Chrome's, otherwise Chrome's like that.
Right. So,
Otherwise, it's saying you can also check into camera permissions for specific sites like YouTube and Chrome site settings under privacy and security. Oh, yeah, that sounds familiar.
Okay. So,
Privacy and security.
where would that be?
Might be down the bottom. I'll try settings again. Yeah, privacy and security.
Okay.
Use camera options for specific sites.
And
That would be like YouTube, enable camera or something.
Yeah. Shields. Maybe this allowed camera. It says that it's allowed.
Maybe you need to add another camera or something. Maybe it's saying default camera, not external camera.
So that's a.
What was it at the top?
Where is that?
Camera allow. Go to camera allow. Go to camera allow. And then maybe try refresh. It says like as well.
Right.
Shouldn't. Because you've got an update as well.
Right. So it looks like we have only got audio. So the question would be whether or not we do an audio one or not. if anybody wants us to continue. Like, I guess what's so good about our pretty faces, Mark? Let's be honest.
Well, my mother says lots of things.
So what I'm going to say on this is, sorry, there is no video, audio only on this one. All right, guys, apologies for that, and thank you for your patience. We know we've got a few people there, so let's just get stuck into it. And then this is a really good lesson for what we should do next time in terms of installing updates before we go live on YouTube, right? So, all right. So today what we're going to do is we're going to be talking, this is our, actually, believe it or not, it might be hard to believe, but this is our first mortgage strategy live webinar. And the reason why we're doing this is because we get a lot of queries during the week around, hey, what should we do with refixing our mortgage? And I know the conversations that I hear Mike having and that I have myself occasionally, they're all kind of similar in that we follow a framework which helps people to come to that decision. We call that the inside out framework. And really the idea is to get people to consider what's happening in their own worlds first, and then consider what's happening in the broader economic landscape before making a decision around fixing their interest rate. Borrowing to buy a property is one of the biggest financial decisions we make, but often we gamble with that decision. We don't actually take it too seriously, or we speculate on where rates are going to go. So I'm going to hand it over to Mike in a second, but just for a quick intro, my name is Darcy Ungaro. I'm a financial advisor. I work in the area of financial planning and wealth. And Mike?
I'm Mike Willoughby. So I've started working with Darcy in 2024. I'm a financial advisor as well. I specialize in mortgages, insurance, and KiwiSaver.
Cool. Awesome. So we're going to start straight into this. And maybe the first thing to do, Mike, is just if you could share like how you start the conversation with someone when they're asking you, hey, what should we do with refixing our mortgage? What's the first thing that you kind of think of, or how do you take people through that?
Yeah, good question. And certainly heard that a lot this year, as a lot of people have been looking at shorter term rates in anticipation of what rates are going to do, which I know Darcy will cover later on. One of the first things I hear, I suppose, before I think about is what is the best rate? So when I hear that, I need to ask you guys a few more questions first, and then help understand the rate for you might not be the lowest rate. It may be another rate for a variety of reasons. So what I love doing is my job and getting to know you guys and understanding what rate's going to work for you. And then we have some consideration, of course, in terms of what Darcy thinks rates might be doing, what you think rates might be doing, what I think rates might be doing. And then what we try and do is come up with simply a rate for you guys that works for your situation.
All right. So what I would like to say to this as well is that, like, if you're thinking about what's happening in the world as the next step, so in other words, like you decide to fix your mortgage rate for a period of time, which is appropriate for the circumstances that you're going through, the next stage is we just think about what's happening in the world a little bit. And one of the big things that I've been watching, well, there's two big things that I've been watching over the past little while, which gives us a bit of a clue as to where interest rates are going, not in the short term, but in the long term. Before that, though, what's happening in the short term? I was just reading an email like literally 10 minutes ago from KiwiBank. KiwiBank's my favorite lender to read emails from because they're so bullish. They're so optimistic about how far interest rates will drop. The official cash rate, the OCR, was 5.5% not that long ago. It's now 3.5%. It's dropped by 2%. And KiwiBank expect it to be around the 2.5% mark by the end of the year. I would be of that view as well. I kind of feel and hope it might need to go down further than that. But what they're really talking about is the OCR. They're not talking about the rates that you're paying at the pump. They're not talking about what you're going to be paying as a borrower. They're talking about the primary ingredient which affects short-term rates. And just as a reminder for those that have just jumped on, we have some technical difficulties, so apologies for this. We only have the webcam working, which doesn't work because I didn't install an update. So if you can hear us, that's awesome. Give us a like, give us a comment, ask a question as we go through this. But unfortunately, we don't have any video this time. So the floating interest rate, the 6-month rate, the 12-month rate, and even the 18-month rate, sometimes the 2-year rate a little bit, is driven primarily with expectations of the OCR, the official cash rate, what that will be at some point in the future, as well as what it is right now. If you're only ever going to be fixing or floating or fixing for a very short period of time, it doesn't really matter what happens in the world. You can afford just to consider things inside of your home, like what Mike's alluding to, like not actually worrying about macroeconomic events, just what's happening in your own circumstances, and get away with it. But there are reasons to think that it's certainly not a foregone conclusion that interest rates could be higher in the future, not lower. And I'm not saying this is a certainty, but I am saying it's a probability. And so with insurance, you always want to consider what's the likelihood of the event happening and what's the magnitude of harm should that event occur. And when you're refixing your mortgage, it is about insurance. It's about risk management. It's not about speculating to get the best deal. So 2 things that I would suggest you ought to think about. And they're a little bit out there, but the first one is the price of gold. What does that say? And then the second thing are bond yields, specifically the 10-year treasury. Now, I know these are terms that you might hear when you're eating, and when you're reading economic reports from economists who have an incentive, by the way, to constantly let you know that rates are dropping so that you get into more debt than you really should. So just watch out for bank economists. There's a little bit of a conflict of interest there, I might have to say. So this is what they don't tell you. They'll tell you what's happening with the OCR because that's easy to kind of, predict this year. But the price of gold has been reaching all-time highs. The reason why and I'm going to say this rather fast, just because for some people it might not be of interest, and it's a little bit complex, so I'm just going to skip over the top of it. But the price of gold, the reason why it's hitting all-time highs recently is because in 2019, the Bank of International Settlements, which is the reserve bank to the reserve banks, if you like, or the central banks, they reclassified gold as what's called a Tier 1 asset. The only other Tier 1 asset are 10-year treasuries or bonds, right, from the United States. And pros and cons between gold and U.S. treasuries, but they reclassified gold as as Tier 1 assets, which caused more investors to take money out of bonds. Central banks take money out of bonds, Russia, China especially, and put it into gold. That's one of the reasons why those central banks have been buying gold. Meanwhile, investors concerned about inflation have been pricing that in. And when they do that, effectively, it puts more pressure on yields. The bond market is saying, hey, inflation will be higher in the future, therefore, so will interest rates. So they price that in, and that's why yields go up. And why that's relevant is that here in little old New Zealand, the official cash rate, the Reserve Bank of New Zealand, the inflation, the immigration, the economic data here in New Zealand doesn't mean diddly squat when it comes to the 3, 4, and 5-year terms. It does kind of, but banks will choose where they get their funding from. But the longer you're borrowing for, the more likely they're going to be sourcing funds that are indirectly and directly influenced by the 10-year treasury. And we've seen the yields increase. A lot of that is driven by investor sentiment. Now, in New Zealand, the narrative is that Trump bad, going to screw the world, therefore inflation, therefore, and there's definitely some truth to that, right? But there's also some truth to this other narrative. And you can believe multiple narratives. It doesn't really matter. You just need to understand what is the risk, i.e., what is the likelihood of this event happening, and what do I have to lose should that occur? And that's where we come right back to the household, where we're thinking about jobs, having kids, moving overseas, selling the home. Mike, when you're talking to people and you're trying to figure out which term is best for them, obviously people read the media, right? Like they're hearing all these terms and wondering what they should do. But how important is that really, in your view?
The main thing is to have a conversation. So we take on board, the excellent analysis that you've just done. You can have your own viewpoints on the analysis from the sources out there, wherever you may get your information from. But what I can confidently say is for the more than 75 refix conversations I've had in 2025, every question around the rate is different. There are nuances. So we take on that on board, and then we want to take on board what is happening for you guys in your world, inside your house, what keeps you up at night, and that sort of thing. So the questions I'm going to talk through you is, hey, no matter whether you're looking to pay off your mortgage faster, are you upgrading school zones anytime, are you going to be purchasing an investment? Unfortunately, we're seeing lots of separations. Maybe then one couple's going to take over the house and their payments and things like that. We've seen people cashing in investments at the moment. We've also seen people splitting securities or renting out their home. That becomes their first investment property. All these sorts of things. So, that's a long list. What I want to touch on is, again, it's an individual consideration. We have a conversation. We're across what rates are doing. We do a little bit of minor psychological analysis as well into what keeps you guys up at night. And then we're going to try and come up with an interest rate that matches your life plans. So what I want to summarize really is to remind everyone, we consider all those things that Darcy's talked about. We consider what's happening in the world, and then we have that conversation with you guys. We try and avoid just chasing the lowest rate because that might not fit your needs. If you simply can't live with the anxiety or your partner saying, I told you so, when rates change, then we may simply just take the rate that for you guys is going to be the lowest. That's what helps you then sleep at night.
I don't know if this is working, Mike, but I think it is. I think we actually have video, if I'm correct here. That looks like us. If anyone can just give us a bit of a heads up by going onto the chat and just saying, hey, can you actually see us? That would be amazing, just so that we know that we're not going crazy and we're not just looking in the mirror here. But it looks like we've actually finally solved the technical issues.
And we did test this, guys, 24 hours ago as well.
Yeah.
So we can only assume that the gremlins came in the night. Everything was working yesterday.
Yeah, no, definitely. So there's a lot to this, right? So I think what we would like to do is really kind of go through a couple of examples in a minute of how this could actually work. Because if you are ever encountered with an uncertain situation where there's more than one avenue, you could either go this way or you could go this way. This way has some pros and cons. This way has some pros and cons. It's really natural to kind of freeze, especially if you're the type of person that likes to do a lot of analysis paralysis, right? And
it's real. Yeah.
It's a real thing. Like we see it all the time. Anytime, and especially when money's involved, like when we're dealing with your mortgage, which often can cost or suck up 40% of your income, that is a significant expense. If choosing to fix it for, say, 12 months versus 3 years, it like works out to be $500 a month in a few years. Mm-hmm. You kind of want to take that seriously. So when we see choices like this, it's natural to kind of get stuck. But the strategy that I have recommended over the years with some people, not everyone, because I think there's some definite pros and cons. And thank you, Ian. You can see us now. We can see you. Thank you very much. There's definite pros and cons with this strategy. But what I want you to talk about, Mike, is the bob each way, the foot in each camp. Why don't you just tell us how that actually works in practice for someone who's borrowing?
Yeah, so hopefully we're all familiar with the saying, right? Hey, what about we just go a bob each way? So what we want to then look at after we've had that conversation with you, we've got to know you. Hopefully you've got some idea on what's happening in the world. You've read Darcy's updates. Maybe you've read one of the banks as well. So we then say, maybe for you guys, the best option could be a bob each way. So what we're going to then consider is, do we just split that loan? We can take a loan that's fixed or floating or whatever. And when you're then considering what you should do for the next term, I don't know what rate to take. I don't know how long I should fix for. Putting a bob each way is hedging rates. So that's going to alleviate a little bit of anxiety and basically protect yourself. So imagine splitting your total loan, the total amount you owe, split it into two. We might then take a shorter rate, a 6 or 12-month rate, and then we might fix the other half, in this example, for longer. So we're providing some protection. If rates keep going up, you can then say, well, cool, well, we've fixed our loan at this amount, but we've also then covered in case of the downside as well. So, sorry, if rates go up, then the downside, you're going to be paying more. But the benefit of that is then you're going to lock in some certainty. So rates go up, your repayments stay the same. This is going to reduce stress and then maybe avoid hearing that "I told you so" conversation at home as well. So the cost of this strategy is if rates go down, you're not going to benefit on that loan, the 50% that you're fixed. So you're stuck on that higher rate if rates do keep going down. But remember, we haven't done that for your whole mortgage. So we haven't gambled in the sense of deciding, well, we think rates are going to go down, so let's put it all on this, and then they don't actually. So you're going to give up a little bit of flexibility in exchange for some stability.
Cool. Now, there's pros and cons with this, and like there's so many variations on this. So by no means is this meant to be prescriptive. This is really just an example. But one of the drawbacks of this, and there are a few, as well as the benefits, is that it increases the likelihood of break fees. And Mike, I'll get you just to explain that actually. Like, what is a break fee, and how can we kind of understand why we have to deal with that break fee, and how can we mitigate having that break fee?
Yeah. So a break fee is we are breaking the contract we've made with the bank. So believe it or not, they don't have a vault full of money. They actually go and borrow that money from somewhere else, like Darcy mentioned, whether it's short term or the longer term, could be offshore, could be onshore from some of the money they do have. Now, when they lend that to us, we then sign a contract and say, we will repay you, and for 12 months, we'll repay you at this rate. That's your interest rate. And then they've made a contract in turn with where they've got the money from. So I don't want you to feel too sorry for the banks, but it penalises them because they've got money that they allocate and can lend out. And then they've said to you guys, cool, that's locked away for 12 months. You're going to be paying this amount. Now, a break fee is if we break that agreement. And for some of those reasons, when I mentioned why we'd want to consider having that conversation with you first, well, if you sell the house, there's not going to be a mortgage anymore because there's no security. So if you have a fixed loan, then you're going to potentially pay a break fee because we've broken that contract. So all those reasons, if we recall, hey, what do you think you might be doing in the next 12, 24, maybe 36 months? Some people are planning. We would then try and say, well, let's avoid a break fee and make an extra payment to the bank for breaking our contract for that money we've borrowed.
Yeah. And one of the other things that can be a little bit complex is actually just the administrative burden of this. And by the way, if you have any questions, we'll roll straight into Q&A time here. I printed out one underneath this laptop here, so I'll grab that in a second. But if you have any questions, just fire away in the chat what those questions are, and we'll jump all over that. But the main issue that I have seen over time with a lot of borrowers is complexity. So if you did a bob each way or a foot in each camp structure where half of your loan might be fixed for 6 months or a year, the other half might be fixed for 2 or 3 years, nice 1 year separation, so it's properly diversified over time. You're capturing both the negative and the positive, the best case, the worst case scenario, awesome. But as time rolls on, you might forget what you were doing. And so I know it sounds really basic, but even just simply putting it into your calendar on your phone. My mortgage expires in 6 weeks' time. Start shopping around. Start going on those websites and actually figuring out which bank is doing what is a good deal. Interest.co.nz, goodreturns.co.nz, two really good places where you can see all the interest rates in one go. If you check out metafinancial.co.nz, there'll be a page on there soon where you can actually put in the details and go through it. Not live yet.
We do have a mortgage calculator, of course, so you can grab the rates from interest.co.nz, jump on the mortgage calculator, and then, maybe you've done your homework prior to having that discussion with us.
Yeah, and then off you go. But as soon as you've done that, you made that decision, put in your diary so that you have a reminder that comes up so that you don't miss it. Because more often than not, what happens, that I've seen anyway, is that loans expire, and when they expire, it's not like the bank forces you to reapply for the mortgage or you have to repay it. It just means that the interest rate is expired and you have to then renegotiate. And it's a bit of a pain because usually the floating interest rate is higher than the fixed interest rate. Not always, but usually. So it's definitely in your best interest to kind of keep ahead of it. So that administrative thing is really important to get right. Often the banks will be sending you reminders or emails, notifications on your online banking saying an interest rate is available. Even though those rates are often algorithmically discounted, it's a really good idea to touch base with a couple of other banks just to make sure it is competitive. Ideally, talk to a mortgage advisor. They'll tell you in one go whether or not it is. And ideally, you'll get some advice, which is really what moves the needle. But yeah, from an administrative point of view, it can be a little bit challenging. And so if you adopt a strategy where there's more than one loan account and they're straddling two different time zones, there's one other really important thing that you need to be aware of, and this probably more applies to property investors, and it's to do with interest only. So, Mike, I'm just going to quickly get you to explain the difference between a loan term, a fixed rate term, and an interest only term.
Yeah, good question. And it's something, look, I even struggle to answer when I check the various, we deal with, say, over a dozen lenders, and then there's non-bank lenders. That information isn't easy to find. Some banks are better than others in terms of where it is on your statement or where it is in your online banking, on your portal. So what we want to look for is, it may then say the loan term or loan term remaining. So quite simply, usually when we've gone and taken out a mortgage, I know if you've chatted to us, then we would have said, hey, we recommend, and you're going to have a 30-year mortgage. So that's the loan term. Now, when you look online or on your statements, you may then see a expiry date of your loan. You may see that as a date, you may see that in months remaining on your loan, or you may see 22 years remaining. So initially, most likely, we'd be setting you up for a 30-year mortgage, so you're going to have the lowest repayments. Of course, we don't leave you to pay off the mortgage in 30 years. And then when you're checking now, what you want to try and look for is an expiry date, which is the remaining loan term, or months remaining, years remaining. So then you can look and say, hey, I've got 22 years left on my mortgage. So fixed rate term, that's if we're then talking with you guys and you are saying, well, my fixed rate, I got this letter or it popped up in my app, an email, of course, hey, your fixed rate expires. Sometimes they'll tell you about 90 days out these days, and then lock in another rate now. Or
it's pretty crazy. Like you just fix your mortgage and then they're quickly telling you, hey, freaking you out, it'll expire one day.
And remember, the banks are they're there to make a profit as well, right? So they want to lock you in with something. They're not there saying, look, this is the best rate you can necessarily always get. And they're not there like everything we've talked about. What is happening in the macro? We can wait longer. So that fixed rate expiry date is then the date that if you've fixed a mortgage sometime in the past is going to be coming up for what we then say is renewal. So you'll have a fixed rate renewal. Hey, it's the, we're into May now. So 30th of May, the loan that you fixed before, whether that was 2 years ago, that's now going to expire on the 30th of May. So that's not the expiry of your mortgage or the date it has to be repaid or anything else like that. That's simply, I took a loan before, I must have then fixed it for a period, and now that date is coming up. So then that's a trigger to have a discussion around sort of like what we mentioned before, get to know what are you guys up to. Well, yeah, quite simply, nothing's changed. You're staying in this house. You're not going to be upgrading, you're not going to be renovating, you're not buying investment property, you're not ending, the relationship's not over or anything like that we've seen this year. Let's just fix again for another 2 years. That's what keeps you guys happy.
And it's important, like when you're putting all this into your diary and stuff in your calendar, just make sure that you note that the interest only period and the loan term and the interest rate fixed rate term, they're all different expiry dates.
Mm.
And sometimes you might still be fixed and you still have interest only term left to run. And other times you might fix for a long period of time, but your interest only runs out 3 months into it. So it's really important to get that, because interest only, if you're a property investor, is very important for tax reasons, for cash flow. You need to keep on top of it, right? So I'm going to read out one question here that we've got from Amanda. And any questions that you have around some of the macro conditions. I know there's a lot of competing ideas around where interest rates will go long term. It is a very, very difficult exercise to put your head through this headspace where you think genuinely that things are going to get cheaper in the future, things are going to get more expensive. Good luck trying to hold both those things in your head at the same time, right? But that is kind of what you need to do if you're going to go through that process strategically. You can't just read what's in the Herald. You definitely cannot read what the bank economists are saying, not because they're stupid at all, but because they are employees of the bank. Do we need to say more? I don't think so. I don't think we do. I went to the bank. So this is Amanda, right? I went to the bank. So I went to the bank to break my loan recently, and it cost over $12,000. Do the banks negotiate on this? So Amanda, this is absolutely a classic. Not classic. It's horrible, but it's common. Totally common. And $12,000 is no small amount. This is actually the reason why it's so important to go through this inside out process well. What's happening in your world, what's happening in the macro world, choose a fixed rate according to those two things put together. If you don't, this is unfortunately what happens. Now, I'm guessing, we don't have this context from the email, but I'm guessing that maybe Amanda wanted to break out of that longer term fixed rate because she saw that interest rates were dropping.
Maybe she sold the property unexpectedly or something like that.
Yeah.
So look, I guess the answer really is get in touch. So what we can do is then run the calculations. Maybe it's actually beneficial to pay the break fee, and then because you're going to be able to borrow more for your next step if the property is sold.
Yeah.
Or it could be beneficial because you need to then, you're buying your first investment or something like that. So we'll do a simple calculation for you. And then, hey, maybe you're getting a cash incentive to go to the new bank as well. So it'll come down to sort of the maths, really.
Yeah. It's a tough one. I went through this personally in August for one of our loan accounts that I had locked in for a longer term. I can't remember what event occurred somewhere around July, August last year, where it was really clear that we had turned a corner. And I thought, nope, that was actually a wrong decision because the balance probabilities was now in favor of rates dropping. So I already had a decent amount fixed for a long term. So we broke it. And yeah, we paid a decent break fee. Now, if I was just to look at that in isolation and say, right, well, that break fee, I need to get a cheaper interest rate now immediately to offset that break fee. I probably would have found that it would have worked out exactly the same, especially if I had to borrow that money to pay the break fee. There's no real benefit to it. But the reason why I did it is because I had quite a strong belief, which turned out to be correct, thankfully, that interest rates were going to drop fairly swiftly. I was hoping they would drop more by now, to be honest. They need to. That's one of the reasons why I believe the New Zealand economy is in such a funk right now, is because the cost of money is just way too high for where we are actually at. And so I won from that transaction, even though I paid a break fee, but that's very nuanced. And so sometimes it comes from doing the calculations, but other times you have to zoom out and you kind of have to think again, strategically, what do we think is happening in your world, the wider world? Do we really believe interest rates are going to fall to that extent? Because they actually have to drop by a certain amount to justify going through that exercise. So hopefully that makes sense. It's not really a simple answer with a lot of these things, just like it's not a simple answer to say, hey, Mike, what's the cheapest interest rate right now?
And I think really to summarize, Darcy, as well, that, and for Amanda's question, hopefully it's, look, come and talk to us, and we want you to be able to have peace of mind and sleep at night. And we know from the maybe it's biased, but we know from the literature we get from the Financial Service Council and things like them that people do sleep better at night when they've
We
spoken
sleep better
to
as
separately.
Yes, that's right.
When you speak
This
to
ain't
a
Bert and
financial,
Ernie, right?
when you speak to a financial advisor, then people walk away and go, I understand now. And then if something like a break fee came up in the future, then perhaps we'd warn you if the worst happened, then this could occur. So
Yeah.
Yeah.
Cool. So hopefully that was valuable. Still a couple minutes if you want to chuck in a quick question here. We run over time just because you couldn't see our pretty faces. We want to make sure that we've exposed ourselves to the maximum extent allowable under law. So yeah, you can see us now, which is really awesome. Thank you for joining us, and thank you for giving us a go when it's our first time. We're kind of experimenting with this streaming software. There's a couple of links that I will put into the comments afterwards for you to find the calculator that Mike was referring to. I know that you probably found this webinar by either listening to the podcast or subscribing to a newsletter already. But yeah, let us know if it's something that you get value out of, and then we'll keep on rolling it out. We'll give it another go, and we'll be better and more prepared next time, of course, in terms of our equipment.
We'll do our Chrome updates.
We'll do our Chrome updates and flush everything out. It's all good. But yeah, thank you very much, everyone, for joining us, and all the best if you are making that decision around refixing your mortgage. Hopefully now you're going to go there and make a better decision with a bit of a framework. Thanks for dialing in.
Thank you.
All right. And how can I gracefully? Okay, there we go.